Mastering key concepts, such as liquidity sweep, is crucial for optimizing trading strategies. Becoming a professional trader requires an understanding of certain key trading concepts, one of which is the topic of liquidity sweep. This video explores the concept of a liquidity sweep, a pivotal phenomenon within trading that involves large-scale players impacting price movements by triggering clustered pending orders, and how traders can leverage them for deeper trading insights. Before going to the main part of the video, make sure to hit the subscribe button and hit the notifications bell so that you know exactly when new content is released. Also, let us know your questions and topics below, or video topics you want us to cover, as we always take your comments into consideration and love hearing from you all. Liquidity refers to the ability to buy or sell assets quickly without causing significant price changes. High liquidity means that there are sufficient buyers and sellers at any given time, which results in tighter spreads throughout the bid and ask prices and more efficient trading. Liquidity is often visualized as the market's bloodstream. Various participants, including retail investors, institutions, and market makers, contribute to this ecosystem by providing the necessary volume of trades. Liquidity is also dynamic and influenced by factors such as notable news and economic events, which can all affect how quickly assets can be bought or sold. For traders, understanding liquidity is crucial because it affects trading strategies, particularly in terms of entry and exit points in the markets. Within the liquidity sweep process, it's crucial to distinguish between a sweep and a grab. Liquidity sweep is typically a broader movement where the price action moves through a liquidity zone, activating a large volume of orders and thereby affecting a significant range of prices. Liquidity grab is a more targeted and shorter duration maneuver. This involves the price quickly hitting a specific level to trigger orders before reversing direction. This is typically used to grab liquidity by activating stops or pending positions before the price continues to move in the same direction. Spotting a liquidity sweep in the market requires a keen eye for detail and an understanding of where liquidity zones typically form on trading charts. Let's look at some of the key areas to spot liquidity sweep. Equal highs and swing highs are areas where you see selling pressure build up. When the price approaches these levels again, it often indicates that there's a pool of sell orders waiting to be activated, making it a potential liquidity zone. Similarly, equal lows and swing lows are areas that have previously marked. Equal lows or swing lows can attract buying interest. These levels are watched closely by traders, as they may signal an accumulation of buy orders, creating another form of liquidity zone. Dynamic trend lines and channels help traders spot areas where the price is likely to react. Liquidity zones can form above or below these trend lines or within the trend channels, as these are places where retail traders often set their orders in anticipation of a break or bounce. Fibonacci levels is also a common tool in technical analysis. These levels often see a concentration of orders due to their popularity among traders. If you are enjoying the video and found it helpful, please leave a like on this video and a comment, as this goes a long way and helps support our channel. We appreciate it. So let's get back to it. How to use liquidity sweeps in trading. Traders often leverage liquidity sweeps in Forex as strategic indicators within a broader smart money concept framework, particularly in conjunction with order blocks and fair value gaps. Order blocks are essential levels or areas where historical buying or selling was significant enough to impact an asset's direction. These blocks can act as future points of interest, where the price might react due to leftover or renewed interest from market participants. Fair value gaps are areas on a chart that were quickly overlooked in previous movements. These gaps often attract price back to them, as the market seeks to fill these areas by finding the fair value that was previously skipped. The application of liquidity sweeps starts with understanding the current trend, which can be discerned through the market structure, the series of highs and lows that indicate the direction of the market movement. Within the identified trend, traders pinpoint liquidity zones, which could be significant recent swing highs or lows, or areas marked by repeated equal highs, lows, or strong support resistance levels. After identifying a liquidity zone, traders then look for an order block beyond the zone. The presence of a fair value gap near the block enhances the likelihood of the block being reached, as these gaps are frequently filled. When the price moves into the order block, effectively sweeping liquidity, traders may place limit orders at the block with a stop loss just beyond it. This action is often based on the expectation that the order block will trigger a reversal. By combining these elements, trend analysis, liquidity zone identification, and strategic use of order blocks and fair value gaps, traders can create a cohesive strategy that utilizes sweeps to enhance decision-making and potentially improve trading results. Now, if you guys enjoyed this video and found it helpful, please show your support by hitting the thumbs up button, subscribing to our channel, and turning on the notifications bell so that you can keep up to date with new recent releases. Also, leave your questions and thoughts below.